Hello everyone, and welcome to your Glassnode video report for week 36, 2023. So what we are looking at today is several metrics that really show us a bit of a macro view. We're going to zoom out a little bit and really look at things in terms of capital flows. And we've got a lot of really powerful metrics that really describe the aggregate flow of capital. And what I really want to highlight is now that we've seen a bit of weakness, right? We talked about that low volatility regime. We talked about that downside risk. And now that we've seen that play out, what I really want to do is zoom all the way out and look at this thing from a macro perspective. What is the true funds that are flowing in or out of the digital asset space? And really, what does that tell us about the aggregate market structure and where we go from here? So what we're really going to focus on is this very simple concept, which is that the vast majority of capital that comes into or out of this industry comes in via one of three assets: Bitcoin, Ethereum, or stablecoins. There is capital that comes in through some of the other assets and tokens, but it is orders of magnitude less than what we see coming in through those three. And in many ways, where go Bitcoin and where go stablecoins, more or less where goes the market. So rather than looking at the entire complexity of things, what we're just going to do is focus on the majors and look at their relative behavior. How is the supply of stablecoins changing? And in particular, we're going to be looking at how the realized cap of BTC and ETH is changing, because that really is the probably the best representation of true capital flowing in or out. So we're going to go through a few different levels here. We're going to start with our recovering from a Bitcoin bear dashboard, which is this one here. And I just want to highlight some of the weakness that we're starting to see, and specifically which sectors it's actually seeing that across. We're going to look at aggregate capital flow across those three different sets of assets, the relative shifts between them, and a couple of different dominance metrics which just help us understand the market sentiment and where it sits on the current risk curve. Really, this is about looking at capital flow, aka demand, and also in terms of appetite for risk, because obviously the further out on the risk curve it is, that's telling you some kind of information about where the market sits in terms of capital and allocation. So as always, please do give us a rate, a share, and a subscribe. It does help this channel get to more people. If you did miss it, we recently released the Cointime Economics report and video. There is going to be a webinar that goes up on the YouTube channel very shortly, which is myself and Dave Pure, the co-author from ARK Invest. We will really cover that. So if you did miss Cointime Economics, please jump on and check that out. Either download one of the reports or check out the video. It really is it's kind of an exciting feature that that hopefully people are starting to get their heads around. So let's get stuck into our analysis for the week. Okay, so as I mentioned, we're going to start in our recovering from a Bitcoin bear dashboard. Now, you will find this underneath signals in the dashboard, because what we're really trying to do here is bring together a series of different metrics across different regimes of the Bitcoin economy. And this dashboard really has one purpose. We are trying to identify the signs that tell us that a robust uptrend, a bull market, is in play or not. Now, of course, nobody really, the reality of markets is nobody really knows at the time. What we're really doing is looking for confluence. When do we have multiple things across different sectors of the Bitcoin economy that you would like to see, or that we have historically seen? And really, this is just about setting up ideas, right? What do we want to see in the event of a robust uptrend, and do we have those different elements? So what you can see, let me just zoom in a little bit. This is our confluence summary. Now, the way it is set up, there are 4 different categories: pricing models, network momentum or activity, how active the chain is, market profitability, because it's very hard to have profits in a bear market, and the balance of wealth held within the system, hodlers versus speculators. Now, this chart here basically stitches it all together. We're going to come back and look at this. I want to take you through the components first, but really the big takeaway here is that the blue bars, the light blue bars, are 5 out of 8, and the dark blue bars are when all 8 are happening. And again, what we're looking for is a robust uptrend. Now, what you can see is we have a decay. We're actually down around 50%. So our overall signal is telling us that around 4 or 5 of these signals are firing off. We are now well and truly not seeing all 8, and it is cooling off quite significantly. So we're going to dive in and just understand the mechanics of what is going on. So the first one is that we lost our first price signal. We've lost the 200-day moving average. The other one that we look at here is the realized price. So we are not down at the realized price, which is still down in the 20,000s. However, coming back to that coin time economics framework, in many ways, the realized price is not the real cost basis. It largely underestimates it. But I'll leave that for another topic. So we are now below the 200-day moving average, and the reason why this is important is lots of traders use the 200-day as a quick sanity check. Are we in an uptrend or a downtrend? It's kind of a binary system. A lot of traders will wait for that to actually be broken to the upside before it gets back onto their radar. So that is certainly one to pay attention to. Now, moving into the on-chain activity regime, new address momentum, we still have a fairly robust uptick in new addresses. Now, it is important to note that around between 40 and 60%, it varies day to day, of this activity is actually to do with ordinals and inscriptions right now. So whilst there's a lot of addresses moving, I would couple this by looking at our transfer volumes, and what you'll find is that volumes are very low. So it's really telling you that that monetary side, whilst we have robust movement in terms of addresses, we have to just be careful that a good chunk of this, roughly 50%, is actually to do with ordinals and inscriptions, which is fine. That's just a different type of demand, but it's not exactly looking at the monetary valuation of Bitcoin. And that's generally speaking well, at least historically, right? We have to see how the market evolves with ordinals and inscriptions in the mix. Fee pressure is the one that has died off in terms of the on-chain activity. So we have seen this initial spike when ordinals and inscriptions really took off, and it has more or less declined quite significantly. Here we're looking at a 2-year Z-score, and this is basically telling us that we do not have a seriously robust fee market as of this moment, looking at it on a 2-year window. So it is kind of oscillating around that neutral value. Now, moving into the profitability space, a SOPA has now dipped down below 1. So the market is now on net, on average, realizing net losses. And this is a break from the relatively profit-dominated, albeit low, right? We're not talking about boom time that we've seen in previous periods. So it really did struggle to kind of get that initial momentum. We got a bit of positivity, which, to be fair, there was a 100% rally off the bottom. So that positivity was warranted, but it has now reversed into a period of losses. Now, in terms of our profit to loss ratio, this one here, remember, SOPA does not consider the size of an entity. Whales and shrimp have a similar magnitude. When we're looking at things in terms of the profit and loss ratio, we are in the process of it. We're not quite below 1 yet, but it is pushing there. And what this is telling us is that we are moving into a loss-dominated regime, which again is not what you typically see during a robust uptrend. Now, the last one is that if we look at things in terms of the wealth held, we still have quite a few signals telling us that the wealth remains in the favor of the hodlers. So the hodlers still are in command, albeit to a slightly lesser extent. They have been a little bit of spending, but for the most part, we are seeing that long-term holder supply continues to tick higher. And again, this is actually what we typically see during these hangover periods of bear markets. It's very, very low volume. There's little new demand coming in, and it really is just the hodlers that remain. So we still have a signal here on the R-HODL multiple, and we're getting a little bit of softening on the amount of profit in trend. So what we're seeing is that a lot of these things are starting to soften or have softened, and in many ways it kind of aligns with the overall performance that we've seen, right? We've seen it kind of stagnate around that 30,000 level, struggle to get its head above it. And this is really telling us that across multiple angles, right? Confluence, multiple levels, we have been seeing this softening playing out. Now, there is a video down the bottom of this dashboard that goes into a lot more detail. This is when we released it back in January. So you can actually go back and just have a bit of an assessment if that is something on the radar. And just to close this out, now that we've gone through all the different components, you can see that really it is only on-chain activity that has both of them firing, but we noted that fees is kind of up and down, up and down. So really this is quite tentative. You can see that we now have a fairly robust downtrend, and notice when this started to decay. Let's argue that when it got down below, at least, what would this be, 6 out of them, this was actually before our sell-off. So we started getting this weakening right before that sell-off. And again, there's lots of metrics, and we obviously don't cover all of these each week, but it really does show that there's confluence between the derivatives and the volatility markets that we looked at in previous weeks. We see it also in the on-chain space, right? Quite often, certainly in my experience, there's an enormous amount of confluence across these things. It just comes down to having the right tools in the belt at the right time. Okay, so now what we're going to do is look at the Bitcoin and Ethereum. I'm just going to call these the majors, and we're going to look at the stable coins. So really the balance between these, and we're going to zoom right out. We're looking at the macro flow of funds. Now, a lot of these metrics will use the realized cap of Bitcoin and Ethereum because that's looking at all the profit and all the loss. What is the net value? That to me is the best estimate of true capital flowing in and out of the market. The other one is stablecoins, and we're just going to use Stablecoins Supplies because when there's demand, we see stablecoins get minted. When there's less demand, we see stablecoins get redeemed, and people essentially take that cash and move it back out into the fiat world. Now, green is obviously showing us when we have an influx of capital. Red is an outflow of capital. You can see that the deepest part of the bear market, huge capital outflows. Much like our ASOPA metric, we had a period of net inflows. Now, the blue curve is stablecoins, and notice how it's been languishing. I'm actually just going to quickly turn off this, turn off the tooltip for a second. So you can see that the blue section down the bottom here, this is stablecoins, and we'll talk about this more. It's been net outflows for some time. In fact, it's been net outflows since Luna collapsed, more or less. The impulse that we saw at the start of the year was the orange curve, and that is Bitcoin plus Ethereum. Basically, capital was flowing into the majors. It was flowing out from stablecoins. And you can see that all of these have now reverted into net outflows. Let's break this down even further. Green being stablecoins, blue being Ethereum, and orange being Bitcoin. Let me again just quickly turn this tooltip off. A few things to note. Probably not relevant right now, but during the uptrend, notice that Bitcoin capital goes first, Ethereum capital goes second, and stablecoin capital followed that. This is essentially showing us a bit of the risk curve. People are moving into Bitcoin being the primary asset and the one that typically drives these markets. We then see more speculation move into other chains, and following that, generally stablecoins kind of expand when there's lots of demand for leverage and borrowing, and capital starts to move around, VCs start to enter the space. We kind of get this speculative mania, which is often driven by the stablecoin side. Now, you can also see that this has been in a net aggregate outflow. And we can see that really since around, this would be around April or May, we've seen a net decline, certainly in Ethereum. Stablecoins have been consistently negative, and even Bitcoin in the background here has finally started to drop off. So pretty much across all three of the major assets, we have seen capital outflows, or at the very least, weakening inflows in terms of what's been going on, which again, really aligns with kind of this softening of this trend that we've seen. Transitioning to stablecoins. Now, stablecoins are a very interesting beast because there's a lot going on under the surface. So if we look at stablecoins purely on an aggregate supply, total supply, we've got Tether, USDC, we've got DAI, BUSD, and recently we've added True USD because that is the stablecoin that Binance has been moving towards. We can see that on net, there's been a net outflow, right? Stablecoins on net have been being redeemed over time. Now, the other thing to note is that there's been a dominance shift. Tether has increased quite significantly, and really it is gaining ground from USDC. Now, there's a lot of explanations for this. Part of it is that Tether typically has a lot more adoption outside the US markets. USDC tends to be a stablecoin preferred by US investors, and US investors have access to, well, at this point, 5.5% rates on the risk-free asset, which is US Treasuries. Very large parts of the world do not have access to these capital markets. So we're seeing this kind of geographical distribution where Tether is gaining some of that dominance and USDC is losing it. And in part, it is likely due to that just disparity between capital markets and access. But big picture, stablecoin supplies are declining. And in many ways, this is showing a capital outflow in a fairly sustained long term. Since Luna, this has been a net outflow of capital, which you could argue really does sit within the regime of bear market trend. Certainly in terms of bear market hangover, but you could argue within the market of realm of bear market, right? So keeping all these things in mind and just understanding the net capital flows. Now, obviously, when these start to change, that can also be an indicator that the market is starting to see some kind of a shift. But remember, Bitcoin and Ethereum in that previous chart tend to be first, and then we see capital flow towards stablecoins. Now, granted, we've only had one cycle, really. Stablecoins have only been major in the space over the last cycle. So we are talking about a small set of data here. But again, these big picture trends we can kind of pay attention to as they move forward. Now, just this is one last chart I want to look at. Again, stablecoin aggregate supplies. You can see just how negative and persistently negative. Now, it is getting less negative over time, but it is still negative in terms of net flows of stablecoins. So again, one of those things we can pay attention to and watch just in case we get this turnaround and a transition back in the other direction. Now, this is an interesting metric. Now, it does have some assumptions baked into it. The concept here, we just try to use very simple models. And again, we're not looking for the exact answer. We're looking for shifts, changing market dynamics, points of inflection. We're looking for when something has changed. Now, what we're looking at here is only exchange inflows, because exchange inflows typically are the most immediate. Some people will buy their coins and they will hold them there for some time and they withdraw later. There is not as much of a direct link between the purchase of an asset and the actual withdrawal. There can be more of a time delay. It's less immediate. On the other hand, a lot of people send their coins to an exchange with the intention to sell them. Likewise, when stablecoins flow into an exchange, we're assuming here, and again, there's assumptions, but we just try to use these things in as best we can. We assume that stablecoins flowing in is a buy side, right? We just do a very, very simple calculation. This will turn green when there is more USD buy side in terms of stablecoins flowing into exchanges than BTC and ETH sell side, right? So we're basically netting off the stablecoin inflows as buy side, BTC and ETH inflows as sell side, and just netting them off each other. So the first thing is we can see that 2023, and really the back half of 2022, was an inflection point. We saw a significant transition from really some pretty deep and dark sell side to, which this is the great irony, in a bull market and during capitulation style events, we get maximum sell side. Large scale sell side is actually what puts the bull market top in. Likewise, large scale buy side is essentially what puts in a market bottom, and in this instance gave us a 100% rally off the bottom up to 31,000. Now we can see that around the same time that many of our metrics started to signal that there was capital outflows, the same time that we started getting weakening over on this side in many of our on-chain indicators and that recovering from a Bitcoin bear, we started getting a reversal. Again, the magnitude is less important than the fact that something changed. We saw a regime shift in the overall momentum of the market. Now, we have to be very careful because there's a lot of dynamics here, right? Markets are dynamic places. It is why there's many tools that we need to use at our disposal. Within this whole scheme here, we've had enforcement actions against Binance and Coinbase. We've had SEC and BlackRock announcements. There's been all sorts of different events. BUSD has been, had to go into redeem only mode. There's lots of things that have happened here. But the net effect, if we had none of that information as context, is that we saw a decline in the buy side around the 31,000 peak here in April, and it's essentially been a net outflow to neutral ever since, just giving us that kind of general overview, and around the same time that our Bitcoin and Ethereum realized cap started to decline. So the very last topic I want to touch on is a little bit about the risk curve. Now, how we measure the risk curve. Now, the concept here is that generally speaking, that initial flow of funds we saw, capital typically flows into Bitcoin, then it flows towards Ethereum being the second largest asset, and then it flows towards stable coins and many other assets, right? Right out to the long tail of NFTs. This is what we've typically seen over the course of certainly of last cycle. Now, this is just a very, very simple metric, right? Really, it's another way to visualize the ETH-BTC ratio. But typically speaking, Ethereum is a bit of a bellwether for what's going on in terms of the risk curve. As capital flows towards Ethereum, it also typically then flows and spills over further down the risk curve. So all we're looking at here is a ratio between Bitcoin and Ethereum's market caps. We're just looking at the two major assets because the market cap is kind of, when we're looking at only these two, it's a fair assumption. When we start looking at longer tail assets, market cap loses a lot of its signal. Realized cap typically is a bit more useful, but for the large two, we can use market cap. Now, high values up here, which you can see through the 2019 and 2020 period, are Bitcoin dominance. And really, again, it's more about the trend than the absolute value, and low values during peak bull markets, right? Around the same time that we saw capital flowing in towards, away from Bitcoin towards other assets, we see that we move into a period of Ethereum dominance. Now, what we can see here is that there's been a fairly sustained and now multi-year trend of reducing dominance towards Ethereum. We're seeing more capital flowing towards BTC. So again, this is just one of those things we're just trying to understand the risk curve as it stands. And with all of the prior charts we've looked at, this capital outflow regime essentially looks a lot like capital moving higher, back towards more safer assets, higher up the risk stack. And again, this is a very, very typical pattern that we see during these kind of bear market hangovers, long sideways, boring, grinding markets that we saw in 2019 and 2020. We can also see this in the relative trade volume. So this is the dominance of trade volume in futures markets, orange being Bitcoin, blue being Ethereum. We're now at a 70-30 split. And you can see that really 2023 has been a period of Bitcoin dominance. Again, it signifies that there is capital moving higher up the risk curve. Liquidity is less. Capital moves towards liquidity, and there is at the moment 71 or 70% of all trade volume is on Bitcoin and 30% is Ethereum. And if we go back just 8 months ago, we were pretty much at parity, 50-50. So during that period of time, the market had enough liquidity on both sides. These have started to diverge. This is the same for open interest as well. And the last one to look at is purely looking at the amount of funds flowing in and out of exchanges. So just total volume flowing in and out of exchanges on a USD basis to normalize these things, obviously. This metric is just looking at how much of it is Bitcoin, how much of it is Ethereum. We don't care about all the other assets. We're purely looking at, of all of the USD funds flowing in and out, how much of that is Bitcoin related, how much of it is Ethereum related. So higher values here signifies Bitcoin dominance is high, lower value signifies that Ethereum dominance is increasing, and we can see down here that we pretty much were at that 50-50 level. The amount of funds flowing in and out of exchanges was roughly 50-50, around the same time that our trade volume was 50-50. And 2023 has been a period of Bitcoin dominance increasing. So we're at 65, 70, 75% dominance. Just again, we're looking at a very comprehensive picture here. It's macro scale, but you can see there's a lot of consistency. We've got weakening in the on-chain data. We've got weakening in terms of overall risk appetite. And we're also seeing that there still is on-net capital outflows, generally speaking, across the whole space. So thanks for tuning in for that session, folks. Hopefully you found that useful. Again, what we're trying to do here is really zoom out, look at things from a macro scale, and put lots of different pieces of the puzzle together. And what you'll probably see here is that there's a lot of confluence, there's a lot of consistency. Now, most of the metrics that we have here, again, you'll find a dashboard in the description below, but most of these metrics you'll find in our dashboards either under signals for the recovering from a Bitcoin bear chart, or there's a lot of those charts that we just looked at that you'll find under market capital rotation. And capital rotation is really where a lot of this is coming from. We're trying to look at how money is changing and shifting around the system, how much of it is moving towards the majors and in what order, and how much of it is moving towards or out of stablecoins, being the quote pair for a lot of these things. So hopefully you found that useful, and I will see you in the next one. Cheers.